Welcome to this Killick Explains video, and this week I want to take on, as usual, a fairly topical one, which is how to quickly evaluate a firm's financial strength. Now, why am I taking that topic on? Well, it's probably fairly obvious. There have been reports all over the place of firms increasingly struggling. Why would that be the case? Well, inflation and interest rates are both rising. And who knows what the impact of Russia's invasion of Ukraine will be, but it's likely to be inflationary and it's likely to mean rates rise faster. So funding costs for firms are on the increase, and that's not good, particularly for small ones who are running things tight in terms of affordability. I'll come back to that in a moment. Government pandemic schemes are winding up, so some of the underpinning support that used to be there is being whittled away by the government. Lenders are now starting to tighten up their criteria for making loans and for allowing loans to continue. And creditors are starting to circle weaker firms. Now, ironically, that can often happen as things start to improve, because lenders and creditors will take the view there's no point in trying to get your money back when a firm is right up against the wall, because you won't get all of it back, you may get none of it back. But actually, post-pandemic, a window's opened up, bit of a recovery, some growth, where some creditors and lenders are saying, right, now is the time to really push the people we've lent to and test whether they can afford to repay us or not. So, how can investors test financial resilience? Now, there are lots of ways of doing it, so I want to give you my short toolkit. Next to me here, you'll see the ratios I'm about to mention appear one by one, and some extra points. I'm going to just cover the basics, and at the end give you some sources for extra information if you find I go quite quickly. So, how to test financial resilience? Now, the first ratio I like, so this is like bottom up, sleeves rolled up, getting involved, getting into the numbers. So the first one I like is gross margin. Now, the formula will pop up next to me, as I mentioned, gross profit over turnover or sales as a percentage. It's very simple in the sense that the higher the better, the more consistent the better. So it gives you a percentage like 5%, 10%, 20%. Why? Higher the better, more consistent the better, because it's a good way of testing whether a firm can basically overcome short-term bumps in the road. It is a test of resilience. If there's a bit of margin there, it may get a little bit squashed, but it won't completely collapse. So for me, gross margin is simple but effective. Then you've got gearing, followed by interest cover, but gearing is pretty key. It's the level of interest-bearing debt to equity, or contributions of banks and other lenders that demand interest to shareholders, if you like. And some would say that when interest rates are low, firms should be gearing up because it accelerates returns to shareholders. And that is true. But in an environment of inflation, in an environment of rising interest rates, gearing that a firm cannot sustain is dangerous. And that brings me on to this, what do you mean by cannot sustain? Well, it's a bit like if you've got a mortgage. What you might take a look at every now and again is, what is my monthly income in relation to my monthly interest expense on the mortgage? How many times does one cover the other? Well, interest cover, again, slide next to me just now, is that test for a company. It can be done a couple of ways. It can be done using the profit number from the profit and loss account, or it can be done using a cash flow number from the cash flow statement, operating cash flow or free cash flow as a multiple of the interest charge or expense. The higher, the better, and what you don't want to see is that multiple being quickly eroded in the current climate, either because the cushion available to cover it is decreasing, or the charge is increasing, or both. Then cash conversion. In a nutshell, can this business turn profits into cash? How reliably? How effectively? Ideally, you want to see about a one-to-one relationship. You don't want to see big volatility, and you don't want to see that drifting, because we're asking the question, does this business essentially have control over working capital, about which more in a moment. Then asset turnover, big ratio, the relationship between sales or revenue and the assets employed in the business to generate those sales. You want to see a balance here. You want a business which basically is sweating its assets, converting assets into sales, but isn't operating right at the edges. So a very high multiple can be a warning sign, believe it or not. A very low multiple, evidence of sloth. Then the operating cycle, as I call it. Now, this is a combination of several ratios together. So it takes stock days, more next to me as I talk, adds debtor days and deducts creditor days to give a number. And that number is the length of the working capital cycle. So imagine stock days are 10 very simply, debtor days are 20, it's 30 in total, and creditor days are 10. Then you've got 20 as the length of the operating cycle. And essentially, the longer that is, the longer it takes a business to basically pull in the cash it needs to from customers, having paid for stock and its suppliers. So the longer that is, the worse the business it will be in cash flow terms. And if you see that stretching, you want to be careful. Now, some businesses will have a positive operating cycle, some will have a negative one, thinking of supermarkets, for example, who have the benefit of lots of cash coming into the tills before they ever have to pay a supplier. But nonetheless, whatever that number is, keep an eye on it, it's important. And then finally, return on equity or return on capital. I like return on equity, so that's the profit available to shareholders once interest costs have been paid to lenders and so on, as a proportion or a percentage of the equity base of the business. Put simply, you want that higher than the return you'd get from something like a cash account or gilt, something lower risk. You want to be rewarded for taking risk, for investing in companies. You want to see that at a decent level. You want to see it consistently maintained. And one of Terry Smith's sort of legendary fund managers' warning signs is where you see things like the gross margin and return on equity collapsing together. So keep an eye on it, keep an eye on the level, and make sure you're comfortable, make sure you benchmark the company you're looking at against its peer group and so on. Now, that is my package of ratios, if you like, to test the financial strength of a company. Lots of information thrown at you there, so if you'd like to know more, you'd like to take your time looking through some of those, then do go to our library, which is killick.com/learn, and you might look at the shares tab as you sort of glance down this side of that screen. And if you'd like a copy of my guide, How to Invest in Equities, which includes a little bit on some of those ratios and lots of other stuff besides, then do drop me an email, editor@killick.com.